The FASB requires that companies estimate the value of stock options using a pricing model that considers 6 factors. We'll group those 6 factors into 3 categories. The 3 categories are the intrinsic value of the option, and that part of the value addresses what the value of the option is today. Second category is the time value of money, and this takes into consideration that the holder of the option doesn't have to pay the exercise price until they decide to actually exercise the options. And the third category is the volatility of the stock. This graphic shows the 3 categories of option value along with the specific factors that the FASB requires be included to estimate the value of an employee's stock option. First category, the intrinsic value. The 2 factors that determine that are the exercise price of the option, which is the amount of cash that the holder of the security would have to pay the company to obtain stock, compared to the market price. An option would have intrinsic value when the market price exceeds the exercise price. Present value category includes the factors the expected life of the option, so how long does the holder of the security have the right to make this acquisition, the dividend yield, and the risk-free interest rate. Dividend yield, notice, actually reduces the estimated value of the option because the holder of the option does not receive dividends. Those would only go to the current shareholders, so while the person holds the option, they do not receive a cash dividend or a stock dividend. And the final category, volatility, the factor associated with that is the volatility of the stock. Notice that the volatility increases the estimated value of the option, and the reason for that relationship is more volatility makes it more likely that at some point over the life of the option, the market price will exceed the exercise price, meaning that the option would have value. The holder could exercise it, turn around, sell the stock, and make money. Warrants are the second security in that first category of potentially dilutive securities. Warrants are often sold with another security such as common stock so that the common stock is easier to sell or sells for more. How we would account for a warrant depends on whether that warrant is non-detachable, so whether or not it can be separated from the other security, the common stock. If the warrant is non-detachable, we will ignore the warrant because what happens is the holder either has the common stock or the warrant. They can't have both. If the warrant, however, is detachable, from an accounting perspective, we'll treat this as a sale of 2 securities and we'll need to assign value to both. The accounting methods to do that are the proportional or incremental method. These are the same methods that we talked about in Chapter 15 when we discussed allocating the value of stock issued with another security. Rights are used by a company to maintain current owners' proportional ownership when that company is going to sell additional shares of common stock. From an accounting perspective, we do not record anything related to the issuance of the rights. If the owner of the right decides to exercise it, the exercise would be recorded as a sale of common stock. The treasury stock method is used to determine whether the option, warrant, or right is potentially dilutive. The treasury stock method is going to make 2 assumptions. First one is that the cash proceeds from the exercise of the option, warrant, or right are used to purchase treasury stock. Second assumption is that that purchase of treasury stock is estimated at the average market price. What will happen is when the market price is more than the exercise price, the company will not be able to purchase as much stock as they would be issuing. Because of that, the security would be dilutive. The following example illustrates how the treasury stock method works. In this example, the company has issued 1,000 options to its employees, and those options have an exercise price of $50. The average market price of the company's stock during the year has been $80. So the impact on earnings per share would be that the company would be issuing 1,000 shares of stock, and using the $80 average price of the stock, the 1,000 options with an exercise price of $50 per option would generate $50,000 of cash coming into the company. Treasury stock method says, well, let's assume this cash is used to purchase treasury stock, and if we assume that purchase is at an average price of $80 per share, the company would be able to repurchase 625 shares of their common stock. The difference between the shares that they repurchase and what they issue is 375 shares, and that would be the dilutive impact of the options. The number of shares issued beyond what could be repurchased given the exercise price represents the dilutive effect of that security. The second category of potentially dilutive securities is called convertible securities. This category includes preferred stock or debt, where the owner of that security can convert or exchange it into common stock. We would record the common stock issued at that conversion based on the book value of the security given up. The method used to determine whether or not the convertible securities are dilutive is the if converted method. This approach looks at the impact if the security was converted. So the earnings per incremental share is computed as the additional dollars available to common shareholders, and this is the good news. These are the extra dollars that the common shareholders would have a right to if the other security wasn't in the company's capital structure. So with a debt security, those additional dollars would be interest that was saved. With preferred stock, that would be preferred stock dividends that were saved, dollars that were now available to the common shareholders. So the good news in the numerator is divided by the bad news in the denominator. And the bad news is the additional shares of common stock that the company would have to issue with the conversion. For the computation of the dollars saved, we'll assume that the conversion happened at the earliest possible time in the year. So if the security was issued during the year, we'll look at the dollars from the issue date on. If the security had been issued in a previous year, we use the beginning of the year. Contingent shares are the third category of potentially dilutive securities. These are shares that will be issued when or if something happens in the future. So whether or not they're issued is contingent upon something happening. If the issuance of those shares depends on simply the passage of time, which would be the case with a stock dividend or a split, where once the date rolls around, the company will be issuing the shares, then we're going to include those shares in the computation of both basic and diluted earnings per share. Alternatively, if the shares being issued depends on the company meeting some specified criteria, we'll have to evaluate whether or not that criteria is met based on current conditions. This chart provides a summary of the impact of the different types of items that we talked about on the numerator and the denominator in terms of computing incremental earnings per share. And that's the EPS estimate that we use to initially determine whether or not a security is potentially dilutive. As long as incremental earnings per share is initially less than basic EPS, that security will be considered potentially dilutive. When a company has more than one potentially dilutive security, GAAP requires that they be pulled into the computation of diluted earnings per share in a specific order. And that order is from the one that will have the most impact or is the most dilutive, so has the lowest earnings per incremental share computation, to the least dilutive. This topic is covered in Appendix 16B. The following slides provide our comparison of GAAP to IFRS. On a detailed topic like dilutive security and earnings per share, you will see as you review the slides that there are a number of areas where there are slight differences between GAAP and IFRS. Most companies that convert to IFRS see a substantial increase in earnings per share, not necessarily due to the computation of earnings per share, but that in general IFRS allows quicker revenue recognition.